Back on October 17th, U.S. two-year Treasury yields hit a 17-year high of 5.22%. Now that high came after a week of higher than expected numbers from both September CPI and PPI, leading markets to believe in the Fed's message of higher for longer. Now since that time, two-year yields collapsed to a low of 4.55% on December 1st. The drop in yields gained steam as a string of inflation data began to come in lower than expected, including the November 14th print of 3.2% in the CPI and a weaker than expected jobs number on November 3rd. In the last 10 days, though, there's been a slight change in economic data and in the narrative, as a couple of data points have surprising results. First was the higher than expected jobs number on December 8th, and then the CPI number on December 12th. Now, the CPI was a hair higher than expected, and the initial reaction in two-year yields was a drop from 4.68% to 4.64%, but then a rally up to 4.74% as traders digested the ramifications of the data. Now all eyes will be on the Fed announcement on December 13th. Of course, expectations are overwhelmingly for no rate move at all. However, what's important is to hear the comments from Federal Reserve Chairman Jay Powell and to see the dot plots from the Fed members. Now, if a trader believes that yields could move higher from here, they could express that by buying the December micro two-year Treasury yield futures contract at 4.65 and target a move to the November 24th high of 4.95. A stop for this trade could be placed below at 4.45. This trade could make $300 if the target is reached and risks $200 if you're stopped out of your level. Now, if a trader believes that yields could move lower from here, they could sell that December micro two-year Treasury yield futures contract at 4.65 and target a move back to the June 1st low of 4.35. A stop for this trade could be placed above at 4.88. This trade can make $300 if the target is reached and risks $230 if you're stopped out of your level.